Hey everyone, this is Kyle Wiggs with Exact Strategies. So far, we've talked about the first two steps in the process, which is really to outline the fact that our technology is intended to force investment companies to compete. And we talked about the relationship between risk and return and the importance of having technology that can observe and react accordingly. The second step was really to go through how do you relate the technology to the clients and prospects that you connect with. And the third step after that is to help them understand, okay, a little more detail, what does the process look like? And so this piece here, which is our portfolio construction process, is designed to help you walk the clients through step by step and then visually show them how it exactly works. So if you think about the industry today, as all of you are aware, we've got tens of thousands of products available to us. We have individual securities, we have mutual funds, we have open and closed end. We've got thousands upon thousands of ETFs with new issues consistently coming to market. And the question is, how does one company, how does one advisor keep up with all of that? And therein lies the importance of using technology to help us objectively make recommendations that we believe can lead to better investment outcomes long term. So in terms of our portfolio construction process, the first four steps apply to both the alpha and beta mode portfolios. Steps 1 and 2 are table stakes. These are the first two steps that every financial advisor should be doing on behalf of their clients. So they sit down with a client and they establish the goals, right? So what is the plan of action? What are we trying to accomplish with this particular pool of money? The second step is to then go through a risk assessment and based upon the goals, assign a risk profile that's suitable for the client. And then from there to choose an investment strategy. And so if we think of Vanguard as an example, if we're going through that process and only using Vanguard, we would understand the goal of the portfolio. We would assign a risk tolerance based on the risk assessment, and we'd choose from one of the 10 portfolios, and we'd meet once a year just to make sure that nothing has changed. We think there's a much better way by using technology to optimize the client portfolios. So with Exact in step 3, what our technology and your portfolios are doing is we're really working with an optimal list of securities. Again, if you think about all the ETFs that are out there that are in your portfolios, each custodian has its own ticket-free lineup. Each RIA or broker-dealer may have a set of parameters that are unique and specific. And so we work with you to understand all of those variabilities. And then from there, we're going to choose an optimal list of ETFs or mutual funds that we're going to expose the technology within your portfolios. Step 4 is we're not going to wait once a year to take action. The technology at the close of every day is going to take the price of the investments in your portfolios, and it's going to measure that. And it's going to do one of two things. In the alpha mode portfolios, each security is going to be given a composite score through the 7-factor algorithm that is looking to determine how is each piece of this portfolio behaving based on the current conditions in the marketplace. And it's really looking for, in step 6, the most durable, the most productive investments from the lineup. That could be, again, anywhere from stocks to bonds, U.S. to international. And if cash, which gets assigned a composite score every day as well, happens to be the best place to be, then it'll make cash as that recommendation. In the beta mode portfolios, the same first 4 steps are accomplished by assigning a goal, establishing risk, optimizing the universe, and then giving it a daily score. The difference is we're asking the technology in beta mode to observe a different behavior. Whereas in alpha mode, we're looking for durability, productivity. Think back to Google Maps. What's the most effective way to get from point A to point B? In beta mode, what we're doing is we're observing volatility. Where is the volatility in the marketplace relative to the investments in my portfolio? And each of the investments is going to be assigned a volatility score. And then at the start of each quarter, the portfolio and all of the underlying holdings will adjust its percentage accordingly. So if we need to increase our risk exposure or decrease our risk exposure, the technology will automatically make those adjustments for us. And so, as a visual reminder of what that looks like, in a traditional 60/40 strategic asset allocation, you are going to establish a predetermined percentage of the investments that will be in your client's portfolio. And on an annual basis, typically, the portfolio manager, in this case Vanguard, is going to rebalance the portfolio back to the target allocation. There's a couple of issues with this. Potentially, you could put your clients in a situation where they could be selling an investment that's working well to buy one that's not working as well simply because it's January and it's not December. And so you could potentially be selling winners to buy losers just because we've turned the calendar. And we think there's a better way. So in beta mode, as a reminder, what we're doing is visually here, we're taking a similar risk tolerance as we have with Vanguard, but what we're visually representing is here we're showing on an annual basis, but as you know, on a quarterly basis, we are going to adjust the percentage of the underlying holdings as the conditions in the broad market as well as the individual securities in the portfolio adjust based on current volatility characteristics. And in our Alpha series, as we contrast what's going on in the traditional asset allocation portfolios, in our Alpha series, as you know, we are going to, on a consistent basis, look for productivity. And as unproductive investments are no longer showing that they are the best place to be, we will sell those and replace them with, in some cases, it could be emerging markets into small cap. In other cases, it could be large cap value into tips or large cap value into cash. And it's really about observing current volatility, applying that to the universe of optimal securities, and looking to choose the most productive investments in our Alpha series and ensuring that we've got the appropriate risk tolerance in our Beta series.